Hey Bowtie Nation, Joseph Hogue with your weekly stock market update, 9 a.m. every Monday with the stocks to watch this week and the stock market news you need to see. And Nation, trading on insider information is illegal. The non-public information inside boardrooms and the executive suites of companies has the potential to swing a stock wildly, but to keep a level playing field, the SEC prohibits inside info from being used by those in the know. There is one way to get that information legally, though, and use it to grow your portfolio. We're going to look into Nvidia's most recent 13F, the legal filing reporting those stocks that the company is buying based on its own inside information, and how you can piggyback on its expertise in artificial intelligence. Stick around after that, and I'll highlight the stocks I'm watching this week, including important updates to Alibaba, ChargePoint Holdings, and Salesforce. First though, with the bull market looking a little tired over the past 2 weeks, I'm investing my free cash for a 7% yield in Worthy Bonds, a fixed income platform with bonds backed by small business and short-term real estate loans. You can invest as little as $10 per bond and earn interest on a daily basis. Best of all, you can withdraw all or some of your money anytime with no fees or penalties. Worthy even has a roundup feature that lets you invest your spare change on purchases into bonds, automatically building your portfolio. I'll leave a link in the description for more information. Use the link and you're going to get an exclusive deal I worked out for everyone in the Bowtie Nation. Buy 5 bonds and get 1 free. Invest just $50 and get a $10 bond free. That is a 20% return on top of that 7% interest rate. So look for the link below or just scan this QR code here. Back to our main topic, and folks, no other chip maker can replicate the kind of performance we see in Nvidia chips, the ability to run those AI operations. Now that means if you're a company using artificial intelligence, you're probably going to be using Nvidia semiconductors, whether in your products or in your data centers to train your software. And all this means Nvidia has its finger on the pulse of AI, giving it that special insight, that inside information into which technologies and which companies have the most potential. All Nvidia has to do is look through its customer list. And it turns out Nvidia has used that inside information for its own gain, buying strategic and investment positions in the companies that could lead in the next phase of artificial intelligence. Nvidia holds investments in 40 other companies, along with 87 subsidiaries and 13 merged or pending acquisitions. Now, while most of these are private companies, 5 of them are publicly traded stocks, giving you the opportunity to piggyback on Nvidia's special position in AI. And how do we know this? Every company or large institutional investor is required to file a Form 13F with the Securities and Exchange Commission, the SEC, disclosing their investments in publicly traded stocks. That disclosure is meant to help the SEC head off any possible stock price manipulation by hedge funds and other big money players, but can also be used by investors to jump on those investments ahead of an acquisition or just a bump in the price. You can always find these 13F filings by going to the SEC EDGAR database online and searching for the company name. Then click through where you see the most recent 13F report for a list of those investments. Now, it is important to note here, not all of these investments in another company are worth jumping in on. For example, Google is known for investing in private companies it might eventually want to acquire. And these kinds of strategic investments could mean a bump in the share price eventually if that acquisition is made, but could be years into the future and may never happen. But then a recent change in Nvidia's holdings tells me that might not be the case here. Earlier this year, Nvidia disclosed it had held nearly a 14% stake of sidewalk delivery startup Serve Robotics heading into its April IPO of shares after a 2022 investment of $10 million into the company. That position was worth about $17 million after the IPO, but is now gone from Nvidia's most recent 13F report, meaning they sold those shares. It leads me to believe that Nvidia is also taking an investment approach here, buying shares in companies it thinks are going to do well in that AI revolution, whether it wants to acquire them into the future or not. And the company just reported $230 million in these 5 stocks. ARM Holdings, ticker ARM, is Nvidia's largest dollar investment with over 1.9 million shares worth $147 million. But because of ARM's massive $126 billion size, only amounts to a 0.19% share of the company, the smallest ownership stake in the list. ARM designs microprocessor architectures, which are the blueprint for semiconductor chips, which are the brains for any electronic device. It then licenses these blueprints out to chipmakers like Nvidia, AMD, and Intel to create their semiconductors. So seeing that potential in this, Nvidia originally tried to acquire the entire company in 2020, reaching an agreement with SoftBank to buy ARM for $40 billion. It would have created an unstoppable powerhouse in AI and a steal compared to that eventual IPO valuation, but the FTC stepped in to stop the acquisition and was called off in 2022. Nvidia still wanted a piece, though, and invested over $147 million in the IPO, giving it a foothold into the company. Shares of ARM have doubled since the IPO last year and are trading at 39 times last year's $3.2 billion revenue, with sales forecasted as high as $4.2 billion this year. Now that is 30% growth, and with recurring royalty revenue becoming a larger part of this total sales here, this one is going to keep building on that growth. From one of the largest to one of the smallest stocks here, at $477 million market cap, NanoX Imaging, ticker NNOX. Nvidia owns just under 60,000 shares, worth $379,000, or about 1% of this medical imaging company. NanoX runs its digital imaging system with an AI-based suite of algorithms to augment that routine CT imaging, highlighting early signs of chronic diseases. The company has a current approval with the FDA and is submitted with the EU and is building out its sales and distribution departments. NanoX is a very early stage and under $10 million in sales over the last year, deep in the red here on profitability, but growth could be off the charts. Analysts expect revenue to jump 147% this year and 200% next to $75 million as the company builds out its U.S. business. And that's typical of many of these Nvidia investments, moonshot investments that could return 10 times the company's money. NanoX trades at a price of 49 times its trailing revenue right now, but if it can hit that $75 million forecast over the next 2 years, it'll make the current $490 million market cap look like a steal. I've highlighted Recursion Pharmaceuticals, RXRX, on the channel recently as a potential 10x stock, and it looks like Nvidia likes it too, with the largest percentage ownership of the 5 stocks. Nvidia owns 7.7 million shares, or about $76 million worth of the $2 billion company. Recursion is leading in the race to decode biology and recently announced its language model, the Orchestrated Workflow Engine, or LOW, to perform complex drug discovery tasks using a natural language interface. This is still a fairly small biotech at just $2 billion market cap. Like most drug developers, it's not profitable yet, but has a strong balance sheet and some very strong intellectual property that, yes, could make it a takeover target eventually, but I think Nvidia's investment here is just pure return play. AI drug discovery is one of the most promising and talked about themes within that larger trend, helping to reduce billions in costs for drug development. I recommended shares of SoundHound AI, ticker SOUN, around $3.77 in February, just before Nvidia disclosed its share of the company, a stake of 1.7 million shares worth $3.7 million, or about 0.5% ownership. SoundHound is a leader in conversational AI to businesses that can be used to build AI assistants in more than 25 languages. Of course, the market for AI assistants could be ginormous, even larger than the $160 billion enterprise market SoundHound estimates here. The speech side of artificial intelligence could be the next big step in AI interactions, and while there are a lot of startups racing to that finish, the investment by Nvidia is a strong vote of confidence in SoundHound. The shares surged 67% in a single day on the release of that investment in February, but came down off the high in March and April. Now, I took advantage of the drop to add more shares, now with a position over 6,000 shares in the company. Like most of these AI stocks, though, SoundHound trades for a rich valuation, but growth and the potential is there. Analysts expect sales to grow by 55% this year and 47% next, while earnings come down to narrow that loss per share. This next one, though, is very interesting for the size of the company. Two Simple Holdings, ticker TSPH, a microcap penny stock at just $62 million market cap, with Nvidia holding 3.5 million shares worth about $3 million and 1.5% of the company. Two Simple was once thought to be the leader in transitioning to an autonomous commercial trucking, a market worth over $1.5 trillion in the US and China alone. The company had already completed several routes with limited or no driver engagements and had operation agreements with the UPS and USPS. But then the company chose to delist from the NASDAQ in January of this year and exit from the US market. Now, Two Simple had been a target of the FBI and SEC investigations into its relationship with other Chinese companies and decided to focus on proving its technology in the Chinese market first. So of all these investments, this is the most interesting for a number of reasons. At first is just the relative size of the company at just $62 million market cap. Two simple issued shares now during the 2021 post-pandemic heyday, valuing the company at $8 billion. That was a ridiculous valuation, but even a return to $1 billion valuation here would be a 1,600% return. But this is also interesting because we really don't know Nvidia's motives here on this stock. It's a new investment just this year, but at $3 million investment, it's not something that's going to move the needle on Nvidia's returns, even if the stock price does bounce higher. So while I think this could be a good Hail Mary investment, I think Nvidia might just be using this instead as a signal to the Chinese government, an olive branch, so to speak, that despite U.S. restrictions on its chips being sold in that country, it's still a proponent of Chinese companies. Now, that is just my opinion, though, so if you have another insight or perspective in this, let us know in the comments in the video. Turning it over to the stocks I'm watching this week. First up, CrowdStrike Holdings, ticker CRWD, one of the last cybersecurity stocks to report its earnings when it releases results on Tuesday. Peers have presented a very mixed picture here, with Fortinet and Palo Alto both warning that enterprise customers were slowing purchasing and seeing their shares slump on the outlook, while Zscaler last week was up as much as 15% on its optimistic outlook for sales. Overall, the cybersecurity ETF, CIBR here, is flat for the year, and the rebound in Zscaler may just be a relief rally from its 23% year-to-date sell-off. That said, CrowdStrike has done a very good job managing earnings in the past, with the stock shooting up higher in 3 of the last 4 reports. That doesn't guarantee investors are going to cheer Tuesday's release, but it does speak to CrowdStrike's ability to manage expectations and then beat them with continued growth. I do own shares into the earnings report as a long-term holding for that cybersecurity mega trend, and would be buying this best of breed in the space on any dips as well. ChargePoint Holdings, ticker CHPT, could be the surprise of the week when it reports its earnings on Wednesday. EVgo disappointed investors on its outlook, sending the stock lower by 12% on the day, while Blink Charging saw its shares higher on its strong results. ChargePoint has more often than not disappointed investors, though, missing expectations in 2 of the last 4 quarters. Against this, that bull case for the larger charging infrastructure is still intact, and this stock trades in deep value territory, which means with expectations extremely low, any good news could send the stock higher. More than a quarter, or 27% of the shares available are sold short, setting up the potential for a short squeeze on any surprise. Now, while the earnings loss for Q1 is only expected to narrow slightly and revenue is forecast expected down 17% from the year-ago period, I'm going to be watching growth in the company's recurring segments area. If it can keep up last quarter's 40% growth in subscription service revenue, it's going to set the company up for solid revenue growth, even as the pace of EV adoption disappoints investors. Shares of Salesforce, ticker CRM, are still up 36% since I first started recommending it as a forever stock in 2022, but plunged 21% Thursday when management warned that a transition period for higher AI spending and softening enterprise customer spending would weigh on its growth for the next 9 to 12 months. Last quarter's single-digit revenue growth was the lowest in the company's post-IPO history, and analysts expect sales to be flat this year. Now, that said, last week's sell-off has made the valuation attractive again at just 6 times revenue, and the company remains a standout leader in its industry. CEO Benioff has continuously proven his ability to grow the company and maintain its competitive advantage over peers, and I'm using the sell-off to pick up more shares. Showing you the bigger picture here with the Sector Spiders sector tracker, despite the apparent weakness in the market index, 8 of the 11 stock sectors did close higher last week. It was only the fact that stocks in the tech sector, now 30% of the entire market, fell so much that it took the S&P index down with it. That 2.3% loss on tech stocks contributed to a 0.7% of the S&P's loss for the week. So had it not been for tech stocks, the S&P could have actually closed higher. While stocks in the energy sector did rebound more than 2%, they're still down 0.33% over the last month, so this kind of strikes me as more of a rebound rally from oversold conditions. The fundamentals for oil are still slightly negative on the current price, so I wouldn't expect oil stocks to continue to outperform. For a little bit longer trend, the bounce higher in interest rate related sectors like real estate and utilities last week was interesting given that rates really didn't move that much. The rate on the 10-year benchmark treasury bond moved only slightly from 4.46 up to 4.51 during the week. Now, that as expected, if PCE inflation report did help ease some fears that the Fed might have to hike rates to slow inflation, but didn't really do much to boost hopes for a rate cut this year. The market expectations are still for a 50-50 chance on the rate cuts are going to start in September. Still, it does appear that interest rates have peaked, so that might be sparking kind of a relief rally in these interest rate sensitive stocks. So especially in real estate stocks, which are deeply discounted on valuation. Get your free bond and earn a 7% yield with Worthy Bonds and the link in the description. Or get someone started investing by gifting them a bond. Click on the video to the right for the top 5 AI stocks I'm buying right now. Stocks with Nvidia-like potential in that AI boom. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.